Good afternoon, everyone. Welcome back. I hope you had a nice break and that you're feeling re-energized, right? Because we do have an impressive group of speakers today, and this is our investment best practices session. I know that I'm excited to host, right? I was an advisory specialist for over 10 years, and I would say the number one question that I would get from the field is, what are other teams doing, right? What are other advisors doing? What's working, and even what's not working? I think we can all acknowledge, right, that there's several challenges in this ever-changing environment, whether it's regulatory, market volatility, or even just general practice management. So, I definitely appreciate the opportunity to be sitting here today with this group, get an understanding of how they were able to adapt over the years and really get to a better place of scale and added efficiency. So let's jump into it. I first want to introduce our panelists and say a special thank you to them for their participation. I'm sure we'll get a lot of value out of the feedback today and their insight. So thank you again. First, to my left here, I have Spencer Carlson, CFA and Managing Partner with Chapel Wealth Management. Then I have Kevin McCurdy, Senior Vice President, CIO and Wealth Advisor with Cooke Financial Group. And I also have Andrew Miller. He's Senior Investment Analyst with Mercer Wealth Management. Okay, so maybe to start first with Kevin, if I could, wanted to talk about the SMA platforms and your utilization of those products, right? We know that Cooke has a long and special history with SMAs, so can you discuss the team's history of not only SMA platform, but their significance in your business today?
Yeah, absolutely, thank you. Thank you for having me be part of the panel today. So John Cooke started the Cooke Financial Group and back in 1969, and John, one of his claims to fame, one of the things that he did for the industry is that he pioneered or helped pioneer SMAs on the retail side. So at that point, SMAs were still very much an institutional construct, and they weren't available to retail investors. And John said, I've got investors, I've got clients who could really utilize these and benefit from all of the positives of SMAs. So that includes lower cost, tax efficiencies, all the things that SMAs provide to us. And to get that same professional money management that the institutional managers, the institutional clients got. And so that's it's been the backbone of our business. It's still 75 to 80% of what we do.
And I do agree. I think we're seeing more and more utilization in that space and being able to outsource to our third-party partners, right? All of the benefits that you mentioned around direct indexing, tax loss harvesting, and really being able to use it in different capacities, right? Whether it's standalone SMA or even in a UMA construct with other sort of tactical tilts. So maybe, Spencer, a question for you, sort of in the same light from a platform standpoint, but maybe a little bit different from a product usage angle, right? We know that your team does a sizable amount of model delivery business with about 85% or so AUM in managed portfolios. Can you discuss the evolution of the practice and how has the investment philosophy changed over the years?
Yeah, I think so. At Chapel Wealth Management, there has been an evolution, but I think I would clarify the philosophy really hasn't changed. What's really changed over the years are the technological developments and the different building blocks and tools to do what we're trying to do to execute our philosophy. But when I first started with the team, 2014, there was I would say less than half of our business was in a managed account. It was a lot of C-share mutual funds. And then on the managed side, back in those days, it was a 1.5% was sort of our standard fee rate for $1 million client, which seems crazy now. It's compressed so much. But we had a lot of challenges with the structure we were using. On the managed side, it was mostly SMAs. And then on the brokerage side with the mutual funds, there were challenges there. We had scalability problems where it was difficult to remember what's going on with each client. It was less standardized. And then there were very big challenges when there would be a world event or anything would happen where we would want to be tactical quickly. It was difficult to do that. In the brokerage side, we'd have to talk to the client. So there was this evolution to more and more in managed, and then also an evolution where we were less the manager. We had an era of rep as PM, but as we wanted to scale the way we wanted to scale, it became obvious the best way to do this was to sort of outsource all of that.
Mm-hmm. Yep, and I do remember vividly through DOL and whatnot, right, the focus.
Yep. Yeah, that actually was a big catalyst for us when there was a time when the interpretation for Merrill, I think, was no brokerage business in IRAs at all. I don't think that lasted. I think that changed, but we heard that and developed a plan. You know what, we're just going all managed. We're just gonna bite the bullet, explain it to each client that we're just gonna go this direction.
Mm-hmm. Great, thank you. And then Andrew, I know we wanted to focus on your adoption of alternative investments. I know your team does a good amount of this business, so how did you get interested in alts, and really what made you decide to start allocating to those products?
Well, we first started looking at alts quite seriously. As it turned out, it was our last few months at Merrill, so we did a lot of due diligence with their platform and their alt people. As the first speaker today said, we had become aware that historically by adding alts to your portfolio, you decrease standard deviation and increase absolute performance, so you get much higher Sharpe ratios, at least historically. And then we left Merrill at the end of 2021, and we actually took the view that interest rates were going up, which I think everybody knew, and that probably wasn't good for equities and certainly not for traditional fixed income. So at that point, we decided to add a good portion of alts to some portfolios. It's not everybody's cup of tea, and I can go into that in more detail later. But yeah, we did a lot of private REITs and private credit, and less so, but some private equity. I think we did less private equity because some correlation with equity markets, and at that point we had a fairly bearish view.
And I think it's pretty powerful even to hear some of the messaging earlier today, right? What a differentiator is, access to maybe more high net worth clients, right? And just diversifying the book further, so appreciate that. Maybe Spencer, to go back to you, to take the model portfolio conversation a bit further, right? We're seeing a consistent uptick in adoption across the industry. So what do you feel are some of the benefits of not only the off-the-shelf, right, more turnkey solutions, but maybe also more customized portfolios?
Yeah, I think first I'd say we actually really like off-the-shelf. You know, coming from Merrill, we were big adopters of what if we're going to be rude, we'll call it the cookie cutter. You know, that was sort of the biggest fear of our group. If we're going all into these pretty basic, this is something you can get anywhere. It's not rocket science. It's sort of commoditized in a way, or was becoming that way. There was a big fear of, will this look too cookie cutter? And we didn't have that experience. We developed a way to explain it, looked at the data of mean variance optimized portfolio, you know, with a basic discussion of those topics with clients was really helpful, and there was very little pushback. But then there was a need for customization, especially leaving Merrill. And it was mostly around the intricacies of the models we had adopted and how we were going to move to new models. As a specific example, we had a lot of Vanguard branded growth index funds. And even though we have tax transition, that's a great tool, we love it. It's way better than the way we would transition a portfolio before. There was this nagging frustration in my mind of, well, if we're Vanguard growth, why do we need to use our precious losses that we're realizing just to switch to an iShares version of that same thing? So that was a pain point. And that's where BlackRock really came in clutch with the custom solutions that they were talking about earlier. I know there's a lot of different offerings around that, but we got to sort of bring our book to them and say, look, here's what we're trying to do. Here's our philosophy. We spent a lot of time with them talking about what we care about, how we wanted the portfolio to look. And they were great at negotiating, allowing some of that, you know, even though Vanguard's not what they're looking to have us in, they allowed some degree of that. And we worked with them on the IRAs to, you know, maybe that's more of a BlackRock focus. So the customization really to get our individual clients no downsides in switching to models, make it easy to embrace models. Mm-hmm.
Yeah, and I agree. I think that there's probably a space for both of those options, right? The turnkey, off-the-shelf portfolios, and then maybe the more customized, depending on the level of involvement and the level of portfolio construction, whether you want certain tactical tilts, right, and leaning on maybe best-in-class thought leadership and asset allocation.
Yeah, and even with like the sanctuary asset management models, if there's any reason why we want to see a more diverse set of providers, we adopt that all the time. We use the sanctuary asset management models. And so, yeah, it really was, the customization was strictly to help us transition everybody.
Right. Perfect, thank you. So maybe I'll pivot over to more of a deep dive into the screening and investment process. So Kevin, if I could, we know that your team has a very sophisticated, disciplined investment process. So can you elaborate on some of those details? What were some of the screening criteria that you would use, or your research and even analytical tools?
Sure. Yeah, so when you're an SMA model delivery like we are, the manager selection process is just super important. So we have, obviously at Sanctuary, we have a roster of really, really good SMA managers that we can pick from. And then we have our own Zephyr license. And so we're able to input all of the data from Zephyr. And we've done coding using Python, which is an Excel coding database system that allows us actually to pull data from, once we tell the system what managers are available, then it just pulls that data from Zephyr into our database. There's a little bit of manual manipulation. I wish it was 100% automated, but we do have to do some work. And then, and we do that in each of the asset classes. We use Lipper as our analytical tool for mutual funds and ETFs. We have, again, we're able to do direct feeds there also. But on the SMA side, we take the available managers, work them through our system, and then we have criteria that we use to try to rank and sort them. But even before we get to that, since we are an active management shop, we believe in active management. Then we look at active share as one of our main screening criteria. And we look very closely at style drift. So we're looking at managers who are actually providing real active management, and they're not benchmark huggers. And because we know the benchmark huggers, everyone in this room knows, that they're going to have a lot of difficulty providing alpha after fees. So we're always looking for high active share managers. That's our first exclusionary criteria. And then again, we're looking for style drift. And we're seeing this a lot in today's day and age, right? So you have a large cap core SMA manager or UMA manager. I'm going to use both of those terms interchangeably. And it turns out that they have sort of wandered into large cap growth instead. We're seeing a lot of that. So you look at a large cap core manager that's on the SMA platform, the numbers look really good. And so you become interested in them only to find out that they're really actually just a large cap growth manager in drag, right? So that's another one of our criteria. And then basically what we do then is that we rank, once we've excluded those managers that don't have high active share, that have style drifted someplace else, we exclude those. Then that's at the point where we do our work in regards to the ranking. So, and then we publish that information to all of our FAs of again where the managers are and using our criteria.
Right. And do you do that on a quarterly basis or more frequently, I guess, as performance figures are released?
Yeah, so for our SMA manager review, that is done on a quarterly basis. That's when the information's updated. Okay, and that's interesting. You mentioned around just categorization, right? I think as we were finding a shameless plug for our focus list as well, if you're not familiar with it, we are building out a more robust research committee or council, I guess I should call it, just spending more time around the more institutionalized process, right? The due diligence, as I mentioned, the analytics. But we did start to find that maybe Morningstar categories or mandates don't necessarily align with a lot of the offerings. So yes, trying to get under the hood, understanding the existing asset allocation, and then really trying to figure out when does it warrant sort of recoding or considering it for a different size and style bucket. It's pretty interesting. And then Andrew, maybe in the same light, from an alternatives angle, right? We know that this can be a very challenging space for research and due diligence. So can you maybe elaborate on some of your routines? So thinking maybe public versus private,
correlation, liquidity, performance, things like that?
Yeah, well, I would say we're very lucky. We're all very lucky at Sanctuary because Patrick McGann's team's done a great job in terms of doing that first layer of due diligence. So we have a certain bucket we can use both in terms of paperwork funds and interval funds. If we're interested in a particular product in a particular segment, we'll have the manager in. What do they do? Where do they do it? Is there leverage? What are the fees? What are the liquidity caps? If we ultimately use the product, we ask for a monthly update. That can be by email, and then we insist on having a quarterly, face-on-face or FaceTime or Zoom, a deeper dive update. Because, as I said, alternatives are not every client's cup of tea, but the ones that do want to use, or we do want to use alternatives, we need to pitch them, the shortfalls and what the thing actually does.
Great. Do you feel, just over the years, the inventory has improved and increased compared to maybe when you first started?
Yeah, very much so. I think it was the early days for alts, not only for us, but also for Sanctuary. And again, Patrick McGann's team's done a great job in terms of expanding the platform. And also, it's become way more user-friendly. I mean, in the early days of Subscribe, we actually, believe it or not, our first few subscriptions, we did manual paperwork. Now it's, Subscribe's got better and better, and the process it's really pretty seamless now.
Okay. Thank you. So this question is actually going to be for all of the panelists. We know you've had a tremendous amount of success, clearly, right? But what were some of the challenges that you faced, and then how did you overcome, I guess, some of those obstacles? So Spencer, maybe you want to start?
For the type of practice we have, I think probably our biggest challenge we face is just operational. Going from Merrill, where we had really adopted our outsourced CIO with Merrill CIO, all of it traded by MA, Managed Account Advisors, then switching to having a new custodian, a new outsourced CIO with BlackRock, and then everything traded by 55IP, that all wasn't clean. That was really tricky. And so I think it was just dealing with the reality that this is kind of hard, making this all work, this is all kind of new, and then just grinding through, and it smooths out and gets better. Not everything's fixed, but just keep that attitude of trying to fix it.
Exactly. Keep working towards the goal there. So,
yeah.
And Kevin, what about you?
Yeah, I would say sort of an ongoing issue with us is that, it's important for everybody in the room that you establish what you think the client experience should be. And it's different for different teams, I understand. But you define that, you say, okay, this is what we want the clients to feel like. This is how it is from an investment standpoint and all the non-investment things that all the teams do for clients. And so you define that, and then, but the tricky thing always is the process to be able to deliver that consistently. I think that's one thing that we continue to. I'm so happy you said overcome as if it was past tense, but it's not quite like that. It's an ongoing process that we have to try to define our client experience and then have a process to make sure that we are doing that consistently. I mean, if you go to any high-end restaurant and you go in the back and you see all these people doing all these different things, and it looks very, very chaotic because they're trying to do things very, very quick. But each of those people has a very, very definite role, and each of them are doing something that's important to that meal, and then it comes out in the front, and it looks terrific, and it tastes terrific, and whatever. It's really just trying to make sure that everybody understands what their roles are and knows what their part of the process is, and make sure that we can do that efficiently and do it consistently.
Great. Yeah, trying to get to that well-oiled machine, right? Yeah. And then Andrew, you want?
I think the challenges, after the initial challenges, which have been more than solved, our challenges have really been at the client level. You've got to be really clear with anybody that buys these things that there is liquidity caps. And these are long-term investments, whether they're growth or income or both. And for example, if you've got an interval funds and you want to get out of it, there's only one date every 3 months. You might hit caps. You have to explain to them that if you want to bail out of this, it could take a year, it could take more. And the caps on monthly REITs, we've run into a bit of that. Not that we're trying to sell wholesale, but if you want to top slice a little bit. So you've got to be very clear with them on that. You always get the question on the private credit funds, why is the NAV not going up? The market's going up. Well, it's an income product. The NAV hopefully over time will not do much, and there's a reason you're getting 10, 11, 12% coupon. And the other big one is there are some products where the subscription monies go out before the position appears on their statement, and that can be quite a considerable lag. And we've learned with experience that you have to explain that very carefully. And any time you explain it, you can explain that till you're blue in the face, but clients always freak out if it looks like you've lost money.
Right. Okay. And maybe just to elaborate further, especially when you mentioned, right, the liquidity concerns, and I think it was Rich who mentioned, right, having access to maybe more liquid portfolios, now with Capstone, right, non-traditional mutual funds and whatnot, and being able to sort of tack them on to other portfolios. Do you see a need? Do you see something in your practice that would benefit, I should say, from something like that?
Yeah, I'm interested to take a look at that. We have actually dabbled in liquid alts before, like managed futures funds, but we haven't had a great experience with those. So, but no, I'd be interested to see the new offering in the new year.
Perfect. And Kevin, actually, this is another question that I would get from the field quite frequently, right? Specific to fixed income managers, right? SMAs versus advisors building their own individual bond ladders, right? Is the cost warranted and whatnot? So do you use fixed income SMAs in your practice? And then maybe could you speak to some of the details around that decision?
Yeah, so again, we're an SMA UMA shop. So absolutely we are using for a fixed income. We don't do we don't do it in-house. I have total respect for all the people who do. But from our standpoint, we have a bunch of really, really outstanding fixed income managers on the SMA UMA platforms. And they're doing things. They have inventory that we wouldn't have at the Cooke Group. They have an expertise that we don't have. The fixed income managers that we use, they're active in their process. So if they see disruptions in the market, they see opportunities, they're taking advantage of those. And I can't quantify what that does in regards to clients' returns, but we think it's pretty significant. So so we're big fans of that.
Okay, great. And I think that's, a lot of the conversations that we've had with our third-party partners around, reducing cash drag, access to inventory, institutional pricing and whatnot. It's pretty powerful, I guess, once you start looking at the numbers and really looking at the value that way. Spencer, for you, maybe to take a closer look at the investment vehicles, right? The active versus passive debate, I know was brought up earlier today. Do you have a preference? And then I guess, how do you have those conversations with clients? Or, do you, I guess, get certain preference from the client directly? So if you could maybe speak to that.
Yeah. I mean, the active passive debate, there was probably a period 7-8 years ago where as a team, we loved that debate. But we've definitely evolved beyond that. I think now we view that as like one of the big questions of the universe. Where's the universe come from? Is active better or passive better? I think we see the nuance in that debate, and I think it's really not the best dichotomy when there's practical realities of what we're trying to do is get clients to do smart things with their money. There's more than one way to do that. We have a healthy respect for that. But our practice, we have moved towards a generally passive. We're mostly passive, and we tell clients why we think they ought to do that. And then we have room for tactical active tilts within our models. That's the way we've constructed it. And that's really helpful to some clients to have that discussion on what's going on in the markets. How are we tilting away from what the standard models say, which we love. 90% of the portfolio is going to stay in the long-term model, and we talk through how that's constructed and why that is. but then have something different going on in the portfolio has been helpful psychologically, if anything. And then we just spend a ton of our time developing a customized planning recommendations for our clients, where individually should you be doing Roth conversion, all the different stuff, the estate planning and financial planning. We go really deep into that. And that's sort of where we just decide this is what the service we're selling, the product we're offering, a piece of it is getting the investment right. And a lot of it is really understanding your specific financial planning needs. So I guess that's, to answer it shorter, we're passive with a little bit of active tilts.
Right. Okay. Yep. Exactly. And I think at Merrill, of course, they talked about the value-based advisor model, right? It's something that really I think resonates well. All the other services that you offer outside of just investment selection, and being sort of the behavioral coach and overall wealth management planning. So there is so much more beyond just the portfolios. Actually, going back to Andrew, if I could, I think Tony brought up a great point earlier today just around questions around asset allocation specific to alts, right? And how there's such a wide spread, it sounds like, between maybe wealth management, family office, and that maybe, not that we can't get it right, but trying to figure out what is that suitable number, right? How do we back into what's appropriate for clients based off of risk profiles, or how do you figure out what an appropriate weighting would be? So if you could maybe talk through that process with your team, that'd be great.
Yeah, again, it depends on the client, it depends on the age. Frankly, it depends on net worth, because obviously higher net worth clients have less of a liquidity need, so those liquidity caps are less of an issue. We would agree with Tony that that if you're going to do it properly. So we probably averaged about, and this is not across the book because so there's plenty of clients that we don't hold alts for, but those that were kind of all in would probably be 25 to 30%. One of the reasons for that was because at the time we didn't like traditional fixed income at all, so we didn't have any of that. And I think to some extent we viewed that as partly a bit of a replacement for that, because we weren't that keen on equities either. And you can't sit there and charge a fee and just sit in cash the whole time. So, but I think going forward we're reviewing what we do on traditional fixed income, but we've still got cash. We've normalized equities. We've upped the equity exposure. I don't see those weightings changing much, if at all, on the alt side. Okay. And by the way, when I say alts, some people include interval funds, some don't. I do. You do.
Okay.
Yeah.
Great. Maybe Spencer, to go back to you, just because I think there is a focus across the industry, maybe to shift where it makes sense, assets from maybe brokerage or a rep as PM, right, into more managed or UMA model portfolios where it makes sense, right? Just for a lot of the benefits that I think that we've discussed around adding scale, having a disciplined investment process, the amount of time that you save, can spend more time with clients, right? Less time on the day-to-day trading and whatnot. So, what do you think, I guess, is the main sort of drivers of that rationale? The rationale meaning why there's still a significant amount of assets sitting in brokerage and rep as PM, and then how can firms help our partner firms shift assets into more of the advisory platform space?
Yeah, that's tough. I don't know I guess collectively what the main cause or reason might be. I think it could be a lot of different things. For us, the only folks that aren't in a model portfolio primarily, the only reason we would do that is a very specific reason to them, to that specific client. But if there's a whole book, I think we had a lot of fear changing to a models base where we're sort of outsourcing the CIO and confessing that to clients. That's a scary thing. Think, wait, that's a part of our secret sauce. Like we approached it a different way. We sort of were as honest as we could be and really thoughtful about how we crafted that message. I've done some CFA exams and some actuarial exams, but I'm an advisor in North Houston. Like, I don't really know the future. And so there's a lot of evidence for an outsourced approach. I really like BlackRock has all these modeling tools. They have Aladdin. I don't have those. I'm sitting talking to clients all day. So that really resonated with our clients. Like, they get, our job is really knowing your individual financial planning needs, and then all day we're talking to different clients about that. it's good we have BlackRock or some big firm with modeling capabilities to help us construct those portfolios. So to me, it would probably just be developing a clear plan of how you're going to make that transition and thinking through all the objections the clients are going to have, and then making a multiple year plan of how you'll transition a book of business. That's what we did. We sort of got forced with this thought that that's where everything was going with DOL, where we thought, oh, we might as well just do this now. And so maybe that helped, that catalyst, but I think it was definitely worth it. We either needed to do that or devote staff to building our own internal CIO, because it wasn't working having advisors needing to manage all these relationships and also it was becoming a huge drag managing a advisor as PM portfolio. And there's just you're not going to be able to grow the way you want to if you're trying to do both those things.
Mm-hmm. Yeah, and I would agree. It's changing a mindset sometimes, right? It's used to doing something a certain way for so long, and I think we start to see, I think it was mentioned earlier today too, the generational gap, sort of bridging that gap, and the needs and the preferences there. And I think in my prior roles, running into just some headwinds with tax consequences, of course. So I think, yeah, tools like even custom core strategies or other taxless harvesting type portfolios, BlackRock and whatnot, and Texas offers.
One thing you can do, just hire a really annoying millennial that thinks they know the way things are going. That'll help you move. I think I probably was that for a number of years, but it was good. We all sort of battled on, here's the old way, what are the merits of it, here's what the new people are saying, what's the danger there, and we wrestled to agreement, and I think it was overall good.
Yeah, and I think I'm definitely excited to hear also we're going to have the tax transition tools early next year, so that'll help shift a lot of the right portfolio A to portfolio B, providing some of that tax impact analysis, being able to set tax budgets and whatnot. So definitely excited for some more of those capabilities that we'll be able to offer to all of our advisors.
Could I just say too, if someone doesn't want to change, that's fine. The only reason anyone should is if there's really good reasons to do it. And that's, I think, the first step is seeing, okay, this is going to be hard and there's a lot of questions, but I actually want to make this transition for a good reason. Exactly,
right. Suitability, of course, above anything else. But if it does make sense, and even having the conversations, I think, over the years with segmentation, right? It's not a one size fits all. It has to make sense for your business. It has to make sense for the client, and figuring out where it fits sort of across the spectrum for your book. Of course, happy to help with that. So we're coming up on time soon. We want to definitely open it up for a Q&A, but maybe one more question for Kevin here. Do you see or hear of any type of stigma around outsourcing investment management, whether it's other advisors or clients? And then how does your team sort of communicate your value prop? I know Spencer mentioned a little bit of that too, is more the value-based strategy. So you do something similar?
Yeah, so from the standpoint of the conversation about passive, so there's a lot of different ways to add alpha to a client's life, and to be, whether that be investments or some other way. We believe in active management from the standpoint that we think it improves the investor experience. So that means both from the standpoint of adding alpha over a benchmark, and then the other thing that I don't think active management gets enough credit for, which is managing downside volatility. So there's a lot of different ways to get to a 9% return over a 20-year time period, and some of those have less volatility than others. Owning SPY, just to pick on one, and paying 12 basis points for it or whatever they charge nowadays, sounds terrific and is terrific in a lot of different ways. But in 2008, peak to trough, you're down 49%. For the calendar year, you're down 38%. So that does not lend itself to a great investor experience. And so we use, just so I can clarify, we actually do use some passive in those asset classes that we can't find managers that we think are going to provide a better investor experience. And I would suggest to you that the CFG, Cooke Financial Group's contribution to the sanctuary galaxy of stars, which is how I refer to all the other groups, is that we continue to talk to active managers And we continue, people call us. We had over 220 meetings last year. People continue to call us, and I give everybody an hour. And in that process, that's their opportunity for them to say, hey, we've got this idea. We're doing something either better than the managers you already have, or we're doing something that's good and different. And I give them an hour. And if I think objectively, it's a manager that the rest of the group, the rest of the sanctuary family, that it would be helpful to their clients, then I'm calling Rich or I'm calling Patrick, and they will tell you that I call them a lot, and say, hey, can you take a look at this? So I haven't, to answer the question, I haven't really experienced any stigma related to that. I think there's a lot of people who aren't quite as sure about the value added to active management, but we still believe it's there. And again, it's there from you have to find the right managers, which is our job, and we have to appreciate what active management is doing for us. It's not just providing better returns vis-a-vis a benchmark. I mean, obviously that's a goal, but the other part of it is, you're getting investment performance in bad markets that is significantly better, and that's a better investor experience.
Great, thank you. So maybe I'll pause there and see if the audience has any questions for the panel. I think Chanel over here.
We're a firm that utilizes models, SMAs, UMAs, and drawdown alternatives. And we are absolutely looking to become a little more automated, a little more efficient by giving some of that responsibility to utilizing models more. Any pitfalls or specific advice that you have for a firm that's kind of using all three and needs to be able to continue to do so in the future, whereas not all model providers can accommodate that? Is there, you look at certain clients and say, well, we want to keep these exposures for you, and so we're going to separate half your book into models and keep half of it in-house, or how do you approach that?
I'm guessing that was for me.
Models
Models guy. So you're saying the reality is each individual client can't fully go into models right away for a variety of different reasons. I think first is exploring, and this is hard work, exploring the details of why they can't. Because a lot of times there are tools that are up and coming, and specifically 55IP. Also, we're hearing talk of it with Pershing X, the ability to tax efficiently transition to a model strategy. So if it's the tax thing, there's some ways around that. There's also even a way around needing to use your tax losses to transition by customizing a portfolio that utilizes the beta exposure that a portfolio already has and counting it as good exposure. But then, I think it's really a painful game of understanding what tools there are out there to solve those problems, and it's no fun, but just one by one find, okay, what's the objection on this client? By the time you do 10 of those, you kind of get an idea of what you're gonna see with all of your clients, and then do that hard work up front of making the plan before you present it, and then of course roll with the punches when something unexpected comes when you're implementing that strategy, and it might take a year or two to do it to the way you wanna do it.
Great. Any other questions for now? Maybe I'll just ask another one, sort of off the cuff. Well, we have a couple minutes, but we're clearly heading into year end. I'm assuming everyone's starting a business plan for 2024. Anything that comes to mind as far as, I guess, how you want to adjust the practice, anything that you're looking to implement, anything you're looking to add, anything that's of interest to you, that's a bit unique. I guess what's maybe a little bit of a sneak peek into your business plan, or something heading into the new year. Anything want to?
Yeah, I mean, I think we've spent this year. We were very not normalised in 2022, and actually it worked out well for us. But we've spent most of the year, we're back to increasing equity weightings to where they probably almost should be, and we've moved back to diversified portfolios. So international, emerging markets, small and mid cap are all part of the equation, which they weren't in 2022. We like our alt positions. There's one or two clients where the FA feels they might have a little bit too much. So there's been a little bit of top slicing going on in some of those positions, but I don't see that changing. The one change we may make is, going back into traditional fixed income, because we really haven't had any for 2 years, which has mostly helped us, but there'll come a point where it won't. So, and we still got the cash to pay for that. So I think that's what we'll do. And I know we're all looking forward to what Marianne has to say tomorrow morning.
Yep, great. So am I.
Yeah, I would say for us, adding alternatives, we absolutely believe in the alternative story, and want to make that a bigger part of our book. And then structured notes is something that we're going to look at a little more closely in 2024. A lot of different products, a lot of really that are designed for a lot of solutions for a lot of different problems, and I think that's going to be a focus of ours to try to figure out how we would incorporate that into our business.
Great.
I think we're most excited about the up and coming technological changes from a tax alpha perspective. That's been a huge growth area of our models, where on the taxable side, if you have just low cost exposure to the S&P 500 through VOO, if it goes down, they just flip it for IVV, and you just kind of do well from a tax perspective. That's oversimplifying. I don't know if that's exactly how they do it with the indexes being the same, but we're really looking forward to these platforms like 55IP being able to not only do that sort of tax loss harvesting, but implementing direct indexing where applicable, all in one clean portfolio. That's sort of the next level of scalability and value add to our clients. And I know everybody's kind of thinking about how to do that the best way, but we're mostly excited to hear about how that goes.
Great, thank you. Any other questions? All right, so I think we'll give you a couple minutes back, but we do appreciate, of course, everyone's time this afternoon. Of course, each of my panelists, that was very insightful. I mean, great feedback, a lot of value I think that everyone can take away and at least apply something to their business going forward. So thank you again, appreciate it.